Hello and welcome to Trader Hindsight. The trade of the week this week was US crude oil on the back of its oil inventory number released on Wednesday. Every week, the Energy Information Administration in the US releases the change in oil inventories. An increase in stockpiles is negative, bearish for oil as it shows lower demand, whereas a decrease in inventories is quite bullish for oil. Okay, so this past week we saw a quite whopping deviation. What was expected was that inventories would climb by 1.2 million barrels. What actually happened was there was an 8.4 million drawdown in inventories, suggesting that Texas tea is quite popular. Okay, but how do you trade this? So let's have a look at the chart. This is the US crude oil chart for Wednesday on a 5 minute. As we can see, nothing much happening in the first half of the chart leading up to the half three release, and then there was the big spike. When I was looking at this, I wasn't looking to get into a trade for crude oil whatsoever. I was just looking to check out the number at half three, move on. But I saw the huge deviation. Like what was expected was a 1.2 million build. What came out was a minus 8.4 million drawdown. That's a deviation of 9.6 million. Like that's huge. Quite bullish report for crude oil. So I had to get a trade on. So there's an initial spike, as we can see here, at half three of 120 points. Then there was the standard retracement that you normally see after any spike, a big spike. It was actually 50% retracement. So I waited till things calmed down at around about 355. I got in. So I got in at this level here. You can see the red mark there in the center of the screen. Now, where to put this? I'm going along. Where to put the stop loss order? Probably a good position in many cases is where the market was trading just before the release. So it's just around about here at 71, um, at around about 71.18. So that's a good stop loss order level. Because I wasn't planning to get into a trade, placing a limit's a bit more tricky. That's the difference between my stop loss order level and my entry level is 106 points, so I just simply chose to use a 106 point difference for my limit order. That's a 1-to-1 risk reward ratio. Now many traders will say that that is the bare minimum that you should be have as a risk reward ratio, 1-to-1. You should normally have a greater, like a 2-to-1 or a 3-to-1. But as I wasn't planning to get into a trade, I hadn't thought it out too much. I just used a simple 1-to-1 ratio. I would have been very disappointed to lose this trade after such a massive drawdown, but I still wanted to get in and get a quick profit and get back out. Anyway, what happened was then, with my limit and my stop in place, what happened was not a lot happened, as we can see in the chart here, for the first hour, and then at around about after half four, US crude oil spiked, and I was limited at around about just before 5 o'clock, taking profit. Now, what subsequently happened after I was limited is actually quite interesting too. Many traders wouldn't have been trading with a limit in this case because there's no obvious signs of resistance, and many traders don't trade with limits. They manage their limit and just the stop loss order is gospel, but you manage your limits. So they would actually stayed in, and that would have been quite a good thing to do in the end, because as we can see here, there's a upward sloping trend line. I'm just drawing it here, developing there, supporting the market, supporting your long position. But what is also here is a bit of a triangle formation. You can see there, symmetrical continuation triangle formation. So often what happens with a market like this, when it starts trading like this, if it breaks to the downside, it can go quite a chunk down. If it breaks to the upside, it can go quite a chunk up. But with the extra support of the upward sloping trend line, that's quite a healthy position to be in if you're in a long position. And as we did see there, the market then subsequently moved up, so that many traders would have stayed in the long position for those three reasons: the upward sloping trend line, the triangle formation, and also don't forget the bullish report, which is driving sentiment and the fundamentals too. So all in all, the oil inventories report was quite positive for oil, and there was a spike of 200 points. So that was the traded week this week. Thanks.